Hey team, Jason Russell, branch manager, Neo Home Loans, on behalf of the Northern Solano Association of Realtors Finance Committee. For everybody who missed our presentation yesterday following the marketing meeting, I figured I would record a digital version that we can upload on YouTube and social for anybody who missed it. So again, I want to say thank you for watching this, and a special thank you as well to everybody who came out to the meeting yesterday. We had a great discussion, great back and forth, and got some good feedback. So hopefully you will find this valuable. The topic today is what we're calling household hostages. In short, we want to talk through our clients who have taken advantage of all-time low interest rates during the pandemic. They live in a home that has a rate of 2.75 or 3 and a quarter, under 4%, and they see interest rates today in the high sixes, low sevens, and say, hey, I want to move, but I just don't want to give up this rate. And for some folks, that is the right answer, right? Like the extra bedroom, the school district might not be worth, going through and losing that rate. But for some folks, I think there's some eye-opening numbers that can be considered. So we're going to walk you through some strategies here today that might land for some of your clients, and your local lender partners might be able to serve in providing that opportunity, at least the data and the insight to those clients with which they can make a more informed decision. So let's kind of jump right into it. So this chart, I'm going to just move my head out of the way here, at least temporarily, so we can see the slides. So this particular chart shows a survey of folks who bought their home kind of during that pandemic window, and kind of what their regrets are and what regrets they have. And as you can see, there's a myriad of different reasons that folks regret their purchase. They spent too much, they had to buy too quickly. Here in Solano County, the average at the peak of that pandemic, the average home was off market within 17 days, and which is, the lowest I've ever seen. So a lot of folks were in that position where they had to buy too quickly, too much maintenance, bought a fixer-upper, got pressured to make an offer, bought sight unseen. I bought a house sight unseen during the pandemic, so while I don't regret it, I can certainly see how I could have potentially fallen into that 17%. Don't like my home's location. Don't like my neighbors. Don't really know what to do about that. But just a higher level of regret than normal, right? And so this goes to show that there is a strong contingent of people who want to move, right? The regret is there. Now, if we look back 15 years to when we had our great financial crisis, lots of people wanted to move then, but they couldn't, right? And the main reason they couldn't move is because of their equity position. They were largely upside down in their homes as foreclosures swept through the real estate community. Home values plummeted, upwards of 25%. And a lot of folks owed more on their homes than they were worth. And so as a result, they either had to unfortunately foreclose or short sale, or they just stuck it out, right? If they had a 30-year fixed and not an ARM, they just stuck it out. And if they did, their house is more than rebounded, and they've got what I'll show you next, which is that equity positions for homeowners are at all-time highs. So this is a little pie chart that will basically show you that over 2/3 of Americans have at least 50% equity in their home. So in other words, if the home value is $500,000, their mortgage balance is at $250,000 or below, right? 39% of homes in America are owned free and clear, completely free and clear, and then another almost 30% have loan to values. Their mortgage is less than half of the value. And then you've got another 32% with homes that have less than 50% equity. Less than 5% of all mortgages are underwater at this point. I think it's closer to 1 or 2%, the last numbers I looked at. And the reason, and those folks essentially are the people who took out, down payment assistance programs and didn't have a down payment in most cases, or they're in a market that went up really fast. They bought at the peak and then it's come down somewhere like Austin, Texas, for example. But for the most part, the vast majority of Americans are in a position to where they can, move if they want to, right? This is kind of showing the same thing in terms of, the average. At the peak of the crisis, the average loan to value in America was 55%, which seems low, but when you factor in that 40% of all the homes are free and clear, that's actually a pretty high number. Fast forward to today, and you can see we're at the lowest number on record. So we have the most amount of equity in the households on record. And if you factor this, the fact that of the majority of net worth in America, the vast majority is held in the form of home equity. So the majority of people's wealth is stored inside the walls of their home and is illiquid. So in other words, you can't reach into the wall and pull out cash, right? Home equity does not appreciate in value. So you've got a lot of folks who are, either interested in moving or even potentially, doing some home improvements or something, but they don't want to get rid of that really low interest rate. And we can see this in a couple of ways. So first things first, you can see this chart. This shows non-housing debt balances. So we are at all-time highs in terms of the average American debt. So as you can see here, student loans, all-time highs, credit cards, all-time highs, auto loans, all-time highs. They did a study in the first quarter, and 17% of all Americans have a car payment above $1,000 a month, which is a crazy figure. So you factor that in with the personal savings rate, which you can see on the chart below. And as you can see, we're basically at all-time lows, right? We hit the very bottom in the middle of 2022 when inflation was hitting the hardest, but we're still below a 5% personal savings rate, which is the worst that we've seen on, at least in modern history, right? Even during 2010, 2011, our savings rates were above 5%. So you combine this, you combine these three factors. The first thing, we have the highest amount of debt, non-mortgage, in history. We have a very low personal savings rate. And thirdly, the vast majority of someone's net worth is built into their home equity. So we have all of this kind of factoring into what we're seeing with our clients. Then you look at the other side of the coin, and you can see that almost 80% of all homeowners, and I should say mortgagers, right? Because 40% of folks don't have a mortgage. But of the other 60% that do have a mortgage, 80% of that number have an interest rate below 4%, right? So again, you fast forward to today and you get to a point where you see that, rates are in the high sixes, low sevens. People don't want to double their interest rate, right? And as a realtor, when you hear that someone isn't interested, you can see here based on this data that there's a wide swath of sellers who want to move, but they look at their current expenses. They go online to a mortgage calculator. They see what a different house looks like at 7% interest. And they say, look, I can't afford another $2,000 a month on my mortgage payment, right? People ultimately are emotionally attached to their low interest rate. But what's really important for us as real estate professionals to try and convey is that the rate is only important to the extent that it impacts your payment and helps achieve your goals. And I want to give you an example of this by showing you a case study of a client that one of you referred over to me recently. And the general consensus for most buyers is that a seller should put all the equity that they get from a sale of their home towards a new home. But why is that, right? Like, why is that the general thing everyone does, right? You pay off you sell your old house, and all the money you get for it, you throw it towards the new home, and go from there. There's no tax advantage to this. It's just what we as a society have always done. And there's another strategy available, and we call it here at NEO, we call it an equity transition plan. And this strategy reviews total cash flow outlays, as well as what we call a blended household debt ratio and a blended household rate, to determine how to best take advantage of equity that exists from selling. So I'm going to quickly move my screen here and kind of give you a lay of the land of this client that I talked to. So this client purchased their home for about $400,000 a couple of years ago. They have an interest rate of 3.25%, and right now they owe $335,000 on their mortgage. Their monthly mortgage payment is $1,992.94, right? So they're paying under $2,000 a month, including taxes and including insurance. So they love their payment, right? They love their payment. Now, what he told me, though, was that he wanted to buy a home that, and I should also say that his current home, talking to the agent, looks like it could sell for about $550,000, and that would net our client about $182,000 after commissions and closing costs are factored in. Now, what I'll also say is, in addition to that $2,000 a month mortgage payment, our client also has $3,611 a month in non-mortgage debt. So in credit cards, student loans, and car loans, he's paying $3,611 a month. Now, you may say to yourself, Jason, you're cherry picking. Nobody has $3,611 a month in monthly debt. That's just not happening. But it really is, right? If you add up all the debt this particular client has, it's $109,000 that he currently owes in these various different debts. The average American household owes $103,000 in non-mortgage debt. So we're not really that far off. It's only a 5% difference versus the average. So if you take that $3,600 and $3,611 that he pays plus the $2,000 mortgage payment, in total he's paying $5,603 a month. Now he makes good income, so this is I wouldn't call it comfortable, but it's manageable, right, to him on a monthly basis. He says to the agent that, yeah, I'd like to buy a $750,000 house, but I went online and I priced out with where rates are at today at 6.875, and my mortgage payment goes from 1992 to 4727. So now, factoring in my debt, instead of $5,600 that I'm paying right now, I'm paying $8,338. That's $2,700 a month more than I'm paying right now. It's more than doubling my mortgage payment. I'm just not comfortable with it. And so, the agent and I were kind of chatting about this client, and I said, well, hey, why don't you just let me talk to him a little bit and kind of get a feel for, what the scenario looks like, right? And one of the things that we can offer here at NEO, and I know many of my local friends in the lending community can do it as well, is what's called a soft credit pull. And basically what a soft credit pull is when, instead of having an inquiry, which many clients are, rightfully concerned about when having their credit pulled, it does not trigger an inquiry. So it doesn't have any impact on their score, but I get to take a look at the entire financial picture so we can sit down and have a really in-depth and robust discussion about their financial future. And so we did this. We pulled the soft credit pull so I could take a look at what he's paying monthly and what his overall finances look like. We had a good discussion, and I sat down with the client and said, well, I understand why you don't want to go from 5,600 to 8,300. This makes total sense to me. Like, I wouldn't want to do that either, right? You want that higher house in the different neighborhood and the different school district, but I get you don't want to pay $2,700 more a month. In fact, doing that would really strain you from a month-to-month basis in your finances, right? And so in general, our clients are going to see this, they're going to go on an online calculator, and that's going to be the end of it, right? And what I would you know suggest to all of you watching this, if you're a realtor, is to see if they're willing to sit down with a local lending professional to have this discussion, right? To see what these numbers look like. And in doing so, we were able to bring out some other strategies, which I want to show you. So this first column is the strategy we just talked about, right? He's going to make $182,000 from the sale of his house. He's going to put it towards his house of $750,000, and he's going to have a loan amount of $584,000. He's going to have an interest rate of 6.875, and he doesn't like that, right? But what I suggested to him is, why don't we look at, potentially trying to pay the debt off instead of taking the full 182,000 and putting it towards the loan, right? So what we did is we ran a scenario where we paid off his $109,000 in debt and used the rest as our down payment. So his cash to close is still the $182,000 that he's going to be netting from the house. We're still using all of it, which we could adjust even further. So he's got a loan amount here of $694. But what happens now, this is where kind of the magic comes in, is his payment, instead of $47.27, it's $56.77. So at first you're like, man, that's another almost $1,000 a month on the monthly payment. That's even worse. But remember, we got rid of $3,611 in monthly payments, right? In addition to the fact that all of this debt was not tax deductible. Now that it's wrapped into the mortgage, it is tax deductible. So we have taken what was a tax benefit of owning a home of about $554 a month. Fast forward to today, we've almost doubled that. So his tax refund is going to be much, much higher. And he's now gotten to the point, remember, his previous payment, including all of his debt, was $56.03 per month. Fast forward to today, we pay off all the debt. He gets the house he wants. Now his payment is $56.77. $70 more a month than he's paying today. He gets the school district he wants. He's going to get an improved tax benefit. He's going to get the house he wants. He's going to be debt free for $70 more a month than he's already paying. This was eye-opening to him. Now, what I kind of then pulled, now this is not earth-shattering, right? Like I would say there's a fair number of loan officers who might be willing to have that discussion with a client to say, hey, why don't we do this instead? But I think the power is in the fact that he was just a no, right? He wasn't a client that was interested that you would normally kick over to your loan officer partner. This is someone who was just a no that I asked my partner to send over my direction just to have a quick conversation, right? It didn't cost the buyer anything. He just had to be willing to let me take a soft credit pull of his scenario and then sit down for 30 minutes to really go over the options. This was eye-opening. The idea that he could do this instead was huge. Now, we then pulled the thread through further though, right? And so one of the things you guys have heard me say over and over and on multiple different videos is that I think interest rates are going to be lower than they are today 12 months from now. Now, they're not going down as fast as I want them to, or as I thought they would, but the premise of rates going down as inflation goes down remains true. The premise that rates go down during a recession remains true. So what I suggested to that client is, look, I don't think I'm going to get you another 3.25% interest rate anytime soon, right? The last time we saw rates in the low threes, they were historic, economic problems, right? Between the great financial crisis and then COVID. I would not expect that you will see rates again anytime soon in that range. But what I do think is very likely is that we could see rates in the low fives, high fours, right? So what does that look like if we refinance you in the future out of this 6.875 into 5%? So if we did the same scenario 6 months from now and we refinance you, and I'm showing him this going from 5%, from 6.875 to 5%, now his total payment goes from 56.77 to 48.44. Now it's less than he's paying right now. He's paying 56.03 today. I'm going to move that forward to 48.44. So now he's actually paying $800 a month less than he's paying right now, and he gets the house. Now, some folks are going to tell me, well, I'll just wait till rates go down to 5%, then I'll do it. The problem is, and we've seen this countless times as rates have temporarily dropped over the last 18 months, is that when rates get close to 6% or below, the buyers come flying back to the market. And now when that happens, you're not going to get that house for 750 because you've got so much competition at that point. So now instead of that, you might be paying 800, which then messes up the whole math, right? And so the strategy of potentially buying now when you don't have as much competition because you're locking in this sales price, whereas the interest rate is temporary. There was the saying that was very, very popular on social media a year ago. I don't love it, but I'm going to use it because you probably have heard it, which is you're going to marry the house and date the rate. While I don't love that in general because I'm a details guy, I get the overall point that they're trying to make, and I agree with it, right? Which is if you can lock in the house at 750 today, this 6.875 and this payment is temporary because we're going to take you to 5%. And then you're saving $800 a month versus what you have right now. Okay. And this scenario really, really intrigued him. And, I lived through 2007, 2008. I did a lot of cash out refinances for clients in 2004, 2005 who paid off debt and then they racked it back up. So, building generational wealth through real estate is a passion of mine, and it's an important piece of my mortgage practice. And so what I suggested to him is, once we pay off this debt, I pulled my inner Dave Ramsey, the good part of Dave Ramsey, and, kind of made him commit to not racking the debt back up. And the reason I said that is because I wanted to make sure when we got to this point of 48.44 a month and we had $800 more to work with, he didn't spend the $800 on a new car. He didn't spend the $800 on a bunch of credit cards. But I showed him a scenario. What happens if we took the $800 and we reinvested it? So if we took the $800 a month savings, once we get there, and we set you up with a local financial planner who sets you up with a balanced portfolio, a 60-40 portfolio that, over time is going to get you somewhere in the range of a 6% rate of return. What would that do for us, right? So in this scenario, you've got your 48.44 mortgage payment, but we're reinvesting the difference. It says custom here, but we're reinvesting, and you can see that over here. We're basically going to take the extra money in a year or so. We're going to assume we can get an 8% rate of return, which is the 30-year average on a 60-40 portfolio. A year from now, you're going to basically put another $760 a month to a financial planner, getting 8% per year on average. What does that do for you, right? This is the discussion that we have to be having with our clients, right? So if we, at this point, we say in 15 years from now, your net worth is 1.2 million, which is great in and of itself, right? We went from $750,000 house. The estimated home value increases in Solano County are such that house 15 years from now should be worth somewhere in the range of 1.2 million. That in and of itself is terrific. That is a powerful sales pitch for real estate as an asset class. And we can talk about that more in depth in the future. But what I wanted to show him in this scenario is if we took the extra money that you're already spending today, right? I'm just getting you back to the 5603 that you're paying today. What would happen? What would I do for you? Your net worth would go from 1.2 to over 1.4 million. I just built an additional $244,000 in net worth. That's a huge difference as it relates to someone's net worth, to their retirement, to all those things. So now, not only have I motivated this client to give him what he wants, which is, I want a new house. By paying off his debt, he was excited about that. He's only paying $70 more. Then I got him even more excited by saying, we can cut that payment by, right about $800 a month. And then if we took that $800 a month, what could a great local financial planner do for you, right? Increase your net worth by $240,000 over 15 years, right? How does that make your retirement look? How does that make your, the age at which you can retire? How does that impact those things? These are the strategies that we have to be willing as local real estate professionals be comfortable presenting. And I say that because, the way that the real estate industry is changing is, and I say this for both any mortgage professionals watching this as well as realtors, technology is coming for us, right? AI, push button get mortgage really wants you to be able to talk to a chat bot in 3 years or less to get a mortgage and eliminate loan officers as a whole. Realtors, you see the iBuyers coming in, right? They want to eliminate the position of being a realtor. And as a result, we have to offer something different, right? Because you're going to have two choices in this industry. You're going to be able to be the cheapest, or you're going to be the most valuable. And you have to decide whether you want to fight the fight to try and be the cheapest, or if you want to provide that next level of expertise and experience to your clients that makes you the most valuable. And something like this absolutely does. And, I obviously it's got Neo stuff all over it because this is a report I created for a client, but these tools are certainly available through MBS Highway, Mortgage Coach that some of our local lender partners use. So I don't want to make this necessarily a Jason sales pitch, but this is the discussion that we should be looking at having, right? And I think that there is a path forward to get through this period in which inventory is so tight, because now that this client's going to list their home, we've created another listing, and we've got another transaction coming on the buy side. So there's just, I think, a ton of value in just being willing to not just take no for an answer, but to have that next level discussion with your clients about just being willing to have a call from with your loan officer partner, so we can go through this. We can do a soft credit pull. We can have these discussions and see if it fits, right? If we have a client who's debt free and has a 2.75% and they don't want to touch it like that, maybe that's not the client that this fits. But given that the average American has $103,000 in household non-mortgage debt, I think there is a huge opportunity to serve those clients and to just educate them on what's possible. So hopefully you found this helpful. If you have any questions, please feel free to reach out. Hope you have a great rest of your day, and we'll talk soon.